Hello, everyone. I'm looking at a lot of new faces. I thought, because I teach senior students, I've seen everybody in the School of Business so far, but unfortunately, this is not the case with this group, other than Natalie. So welcome to this presentation. My name is Dr. Yaseen Alhaj. I am the only finance professor here on campus. This is my 8th year at Middle Georgia State University. I am a certified financial planner. I also work as a succession planning consultant with a big office in Colorado, Denver, Colorado, to be specific. And I'm glad I'm going to spend some time today walking you through some smart investing tips for you to build wealth over time. Thank you very much. The very first thing that I like to start with is to stimulate your thinking about investment. Folks, to many of us, we fail to identify our goal. And because of that, we cannot identify the right tools that will take you from this, where you're at right now, to that goal. So this is the first thing that I hope to get you to think. What exactly you hope to see when you retire? And now that I've been working in this field, like literally hands-on meeting with clients, I see that some of them have different goals. Some, I want to have $1 million. Others will say, no, I need 11, 12 real estate property that can generate income that I can live off. Others will say, no, I am young. I'm only 25. My hope is to retire at the age of 45 and have enough funds in my 401k invested in Charles Schwab high dividends that I can live off of as I'm over the next 40 years until I die or whatever. So every one of us will have a goal, and your job is to identify the goal that you will be happy with. It will satisfy you, satisfy your needs. Some will be okay living off of Social Security and a little bit of income from their 401k. Others will say, no, Social Security is just a minor source of income for me. I want to live 80, 90% off of my 401k and postpone that Social Security until I am 72, 74, or actually 73 right now. You can't postpone it beyond that. And then take advantage of that 8% that the Social Security offers you, to grow that income. So this is number one. The second thing is to get you to think about those investment decisions that you make on a daily basis. And many people, trust me, you think you know it, but when it comes to real life, we do not understand that we are making investment decisions every single moment, not day, every single moment. I could be right now, going with my kids, because yesterday they went to Panera Bread to have lunch. My 16-year-old decided to take her sisters to go to Panera Bread without me, without her mother. So now she has money and she can spend. What I'm trying to say is she's spending. We're getting less rich. Panera is getting richer. So this is the investment decision I am now trying to pass to my kids. And you think it's minor, but when you add everything, you will see how much money you spend on things that you don't really need. Folks, and again, when I was your age, I never viewed these numbers or statistics as anything major. But when I started doing this math for myself, right, I started seeing the numbers and how it adds up very quickly, especially when you spend money on silly things, right? And very quickly, as I said, adds up, and you will end up, for the most part, regret it. I mean, I'm 47, and I am telling you, I have so many regrets, especially when it comes to investments. I'm doing good, thank God, but I am telling you, I wish I can go back 10, 15 years in time. This is just one example, folks. This is assuming that you decided to invest in Apple products, not stock, products, back in 2014. $1,000, I think back then, an iPhone would cost less than $1,000, but let's assume you got yourself a laptop, one of those MacBooks for $1,000. How much it worth today after 11 years. Probably, if any, $100, if any. But if you bought the stock itself, if you invest that $1,000 into the stock, you will have today over, I think as of today, it's close to $10,000. $10,000. So you have grown that money 10 times, right? If you invested in that stock over those 11 or so years. So this is again, we don't think about this stuff, and I think it's a mindset. If I can get you in this 1 hour to shift, not change, completely change your mindset, just shift it a little bit and view the world from that angle, I am super happy. So let's start also by viewing some very important statistics. Remember, I was telling you about statistics earlier and how things you should view and understand and get introduced to. This is some of them. This is you investing $100 a month at 8%. And if you think 8% is too much, you're wrong, because the average in the US market here is close to 10%. And those who had me in Principles of Finance, they know that very well. In the United States, if you invest your money in an index fund like SP 500 over a long period of time, anywhere between 20 to 25 years, you should expect a healthy 9.5%, close to 10%, right? So 8%, I am not being aggressive at all. And assuming that this happened or started at the age of 20 until you're 60, you will have about $305,000 in your account. And this is only $100 a month. Buffett made most of his money, most of his wealth, 99%. Now, I wasn't his accountant, I promise you that. But this is taking from himself. 99% of his wealth was made after he was 50 years old. So you can imagine how powerful this interest and interest can do, right? Another thing about the market average, I think I highlighted this. We are very, very, very close to 10%. And this is when you compare it to the average return you can earn from a saving account, right, is less than 1%. Oh, but Dr. Yaseen, now my bank is offering me 4%. Now it's 4% and 3.5%. What was it a few years ago? Less than 1%. And this is again why we get fooled very quickly. People see numbers and they assume that this is the benchmark. No. This is an unusual benchmark. Folks, in the history of the United States, we've seen two periods only, where that saving rate was above 3, 4, 5%. This now, over the last couple of years, and back in the 70s, right, when interest rate was so high. Of course, we had hyperinflation or close to a hyperinflation back then. And this is why the government was forced to offer high interest rates to absorb that extra liquidity from the market. All right, next is the average American spends over $2,000 a year on subscriptions. And this is me commenting earlier about unnecessary spending, things that you don't add up, you don't pay attention to, and all of a sudden it's a significant amount of money wasted, just literally wasted. Last one, paying the minimum on a $5,000 credit card, assuming that you have a 20%. How many of you know how much interest you pay in your credit card as of today? On average, don't look it up. Thank you very much. So some people are paying attention to their credit card statements. The average today is close to 24%. If you're lucky, you'll get 18. If you're VIP, top credit score, they may give you 18%. But the average is 24, and as he puts it, can get all the way up to 32%. So again, me throwing the 20%, I am very conservative here, very conservative. It could take you 25 years to pay it off. And you will pay in interest alone, over $10,000. Interest alone. This is why when I talk to people and tell them that it's important that you make additional payments toward the principal, whether if it's a credit card or a home loan, this is important. This is essential, right? They don't see this adding up. They see, oh, it's only $10 extra or $20 for the interest, no big deal. But what you don't know, what you don't see, that it adds up and it accumulates over time. All right, so I see some people already playing on their cell phones and they are already bored. And I get it. I get it. Trust me, I've been in this field long enough to know that our topic, unlike accounting, is very, very, very dry, or can be very dry. So I thought, let me just talk about this for a little bit. Because several years ago, I heard how boring investment can be. In fact, people in the field told and I heard it myself, tell their clients, don't expect us to have fun. Nothing excited about this world. And I was like, let me do a little bit more research. And this is what I came up with. I don't know if you know these guys or not, but George Soros is a billionaire and one of the well-known, one of those philanthropists that contributed the most. Folks, this guy donated $32 billion to one foundation, this guy right there. So you can imagine how rich he is. And listen to what he says. He said, if investing is entertaining, so if you're having fun, if you're Wolf of Wall Street, see the movie now? Please tell me you did. All right, then most likely you're not making fun, or maybe you're stealing somebody else's money, right? Most likely you're not making any money, and good investing is boring. And this is very, very, very true. I looked at something else said by Paul Samuelson. I don't know if you know this guy, but he is the first, I don't know if you're paying attention, he is the first US economist to win Nobel Prize in 1970. This is him. This is him right there. So again, not my words, not some guy with investment experience, etc. This is a guy who knows, hopefully, he knows what he's talking about. Investing should be more like watching paint dry. Paint dry? Can you even see such a thing? You just wait for it. And imagine how boring it is just to, is it dry? Is it not? Is it dry? Is it not? Right? Or watch grass. Hello, folks. Watching grass grow. If you want excitement, take $800 and go to Las Vegas. I said this multiple times to clients I work with. Even my students, I tell them, if you think that you need to be entertained in the stock market, in the wealth creation world, then you need to take your money and go to the closest casino and have fun there. I think right now that you have those machines in some gas stations, you can go there and have some, but not in our market. Absolutely not, folks. So I know it is boring, and you need to know this. Don't lie to yourself. Don't hide it. Don't pretend that, no, I'm going to have fun. No, you will not have fun. You will not have fun. It's a boring process. You just leave it there, you put it there, and leave it there. So this is why later on you'll hear me talking about buy and hold. This is one of the best strategies in the world of investment. The best. Buy and hold. Buy and leave it there. 20, 30, 40, 50 years, leave it there. Don't open your account and check it out every night or every couple of hours. This is the worst strategy that you can follow. All right, so let's now start with tips. I got 7 tips for you, 7 tips for you to become a successful investor. As a beginner, we're not talking about you earning the CFA, Chartered Financial Analyst. No, we're talking about someone beginning, someone who does not have a finance background, someone who likes to start and slowly build that wealth. So tip number 1, start early. Folks, time is your best friend. Time is truly your best friend. So a quick example here about a couple. And by the way, I could stretch this to 20, 30, 40, 50 scenarios, not 2. And I have done this with my students. I have done this. We've looked at multiple clients, each starting at a different age, each earning a different return, etc. Math is my thing. I mean, and if you talk to my students, they'll tell you this. I am just obsessed with math. I love running statistics. This is my world, right? So this is one of the experiments that I ran, and this is the other one. Just very quickly, I'm going to show you this. This is my work. I ran these simulations myself, and we do something we call Monte Carlo analysis. Have you heard of Monte Carlo analysis? Anyone? Monte Carlo analysis? I'll talk about this when I look at this. This is one of the most powerful tools in the world of investment. So let me go back here. So this is a very basic scenario that kind of walks you through what will happen if individual one decided to invest $200 at 8% only when she is 20, but her brother, her friend, her husband, her whatever decided to postpone that 10 years, only 10 years, no big deal. Same return, same amount of investment. Look at them when they retire at the age of 60 or so. And by the way, I don't know why I put it at 60. I regret it. I think probably I should push it 5 more years. And this is now becoming the standard in our industry. 65 is the average. Although I feel that Gen Z is pushing. I'm hearing more from younger people that they are interested in retiring at the age of 45. I don't know if you've sensed that. I'm serious. The most important article I read was from a big economist. I can't remember from what university. You know what he said? He said, what are you going to do when you retire at the age of 45? What are you going to do for the next 40 years of your life? I think that was the best article that I read about someone pushing back on this weird decision. And when I say retire, that means retire, like not do anything, not having passive income, not do anything, just retire off of whatever you accumulated in your 401k. So anyway, bottom line is, if you go back to these two scenarios, look at the difference, folks. He or she will reach the 700,000. This is 700,000 versus he will have only 200,000. I hope this is significant enough to make us understand why time is crucial when it comes to investment. And this is just one example. Again, I can run 20, 30, 40, 50 scenarios about this. Time is important. Start as early as possible. And I tell my clients, don't tell me I don't have any. No, it's not about how much do you have. It's about starting with something and committing to it. So this is the next thing I'm going to talk about, consistency. Be consistent. Just do it over and over and over and over again. All right, another thing that I like to highlight, and I'm learning from talking to people, either my students or other people in the field. Folks, they don't understand the difference between nominal and real interest rate. This is very sad. How many of you saw this in your principles of macroeconomics? You see, this is how sad it is. There's no macroecon class should be taught or delivered at any institution without emphasizing this. Nominal interest rate is that interest rate that by law, financial institutions are required to declare, required to share with you or disclose, right? The real interest rate is the one that they never show. Whoops. The real interest rate is the one that they will never show you. So just very quickly, and I'm throwing some example over here, and it's a bit old. And by the way, when I put this together, right, I put it earlier this year. Inflation rate was high. And the nominal rate that we were earning on CDs, anyone have CDs? Do you know what a CD is? Yeah. Thank you. All right. So the average right now is a bit below 4 for 375, 425, if you're willing to put a lot of money, etc. Back then, earlier this year, it was 5%. And the inflation that we had over the last couple of years was closing up to 8%. So when you put everything together, your net true real return is actually -3. In plain English, the purchasing power of every dollar you have invested in that CD dropped, did not go up, dropped by 3%. Dropped by 3%. And this is exactly what many people fail to understand. They just look at the nominal interest rate. Yaseen, this is not an exciting story. Give me something more exciting. I'll give you one. Egypt. I'm from Jordan, in case you are wondering where's this accent from. Jordan, the Middle East, right next to Israel. Egypt, for a long period of time, they were offering 22% returns on US deposits. 22. Are you out of your mind? What's wrong with you? Interact. That means you have to leave this class right now and take advantage of that. 22%. Are you listening? You deposit. You don't need to invest in any investment, any stock, anything. Just put that deposit with the bank and you can earn 22%. I heard from some people, actually, some banks were offering 26%. 26. If you're not amazed by this or shocked, you should be. This is way too high. What's the catch? Can somebody tell me?
That's the nominal rate. That's the nominal rate.
Thank you. And the inflation rate in Egypt is? Can somebody actually, all of you have cell phones. Last 4 or 5 years, what's the inflation rate in Egypt? Right now, look it up. What's the inflation rate in Egypt? Don't tell me what it's been recently, just average over the last couple of years. Where's your AI talent and skills?
12.5 in October 2025.
Okay, before that, I think it went down recently.
25% in November 2020.
Thank you. Thank you. Are you listening? And remember, it was much higher than that. I heard it went close enough to 30, some almost 40%. So when you look at your true rate of return, it's nothing. And the government is smart. Government is smart. They will have you deposit this money and it's locked for an entire year. So it's not like I'm going to take advantage of it for a couple months and then leave the country. No, you're stuck. So anyway, I have a lot of stories to share regarding nominal and real interest rate because it has been the way that money travels internationally. This is one of the things that motivate super rich people, super wealthy people to move money across the globe. This thing right there. Okay. All right, guys, let's keep moving. Second tip, invest consistently, not emotionally. Don't be like, I don't feel like it this month. I'm going to put those $200 or $300. No, that's not the way to do it. And I'm sure you have seen this and heard about this before. Just set that saving rate on a monthly basis or bi-weekly from your pay stop. Just set it and leave it. Have that income after saving, right? And live off of it. That's it. Don't be like, oh, you know what? I'm tied this month. I'm just not going to invest or have any saving this month, but I will double it next month. Don't do that. Don't do this and take it from someone who have seen many clients making that decision and now they regret it big time. Look, I thought I'm going to come back and then I forgot to set that auto saving or whatever. And now look at me. We see it all the time. And this is one more time, the most dangerous thing I think that one could do to their retirement planning of all. So let's now talk about, because remember I told you not emotionally, right? Because this is now the emotional aspect of it. Panicking during recession. So quick story. I'm not disclosing names, but I have a friend of mine who lives in this area who lost over $950,000 during COVID. Yes, you heard that right. Over 950, just because he decided when the market dropped during COVID. I don't know if you remember this. Should be old enough and you remember when the market went down during that period of time. It went down for less than 3 months and it bounced back. So when the market started collapsing, he sold. And he waited around this and he thought, no, the market will collapse again. It's COVID. The whole world will disappear. And then he went back and buy here. $950,000. And yes, this is not an account that I'm dealing with. It just happened to be a friend. $950,000. And this is nothing when you compare it to what happened to larger accounts that trade on emotions. Right? And this is why we, in the world of financial advising, we keep telling them, I don't think I can have, or I don't expect you to have me as an advisor because I have a crystal ball. No, this is not the reason. No, because I don't have a crystal ball. What you need me is to calm you down when the market go through turbulences like this. Calm you down and tell you, no, don't sell. Because you will see that red number on the screen. When you open that account, you'll see that red number. But guess what? It's not realized. You haven't realized the loss yet. You see it, it's there. The market will bounce. No recession in the history of the United States lasted more than 3 years. That's the worst one. So the market will drop and it will recover. 2008, the market collapsed, lost over 50% of its value. When did it recover? 2010. Go look at the statistics. Nothing lasted more than 3 years. So if you're patient, if you're not trading on emotions, you can prevent something like that. Please.
How long was the crash in 2015?
2015 here in the United States, did we have one? It wasn't that substantial. What was the drop? 10-15%? Yeah. And when we say crash, it's usually above 20-30%. That's what we refer to crash. Now, China did have a major crash in 2015, but we had nothing here in the United States, like 10-15%, as you put it. And I, if I'm not mistaken, it did last for less than a year. Less than a year. Yeah. But yeah, China, and by the way, I do have multiple papers published about the Chinese market. So I can't say I am a super expert when it comes to the Chinese market, but I know their history very, very, very well. I've studied this extensively. So yeah, speaking of those, as I said, recessions usually, and we're not making any promises. So when we tell a client, right, that, hey, nothing lasts for more than 2 to 3 years in terms of crash, we're not making any promises. I'm not telling you that, yes, this pattern will continue moving forward. But based on the last 120, 140 years, this is what we have. And we like to believe that the history, to a great extent, will repeat itself. Second thing, chasing hot stocks. NVIDIA. A lot of people made a lot of money. But they're forgetting, folks, that many, did I say many? Did you hear me say many? Yes, stocks before NVIDIA, we thought they're hot, and where are they? 20 minutes ago, 30 minutes ago, was it? I don't know, Natalie. Well, an hour ago, I was telling my students about the tulip mania. How many of you heard about tulip mania? You see, this is another sad story. If I tell you, have you heard about this and this in TikTok? The whole class will say, oh yeah, I watched this morning. Tulip mania is the first recorded bubble in the history of humanity. Started in 1783, somewhere in West Europe. Farmers buying and selling tulips. Tulips, do you guys know what tulips? Tulip. Back then, tulips, before that date, tulips had one color. One. That year, they got infected by some kind of a bacteria, causing those tulips to develop 2, maybe 3 colors. And people thought that, oh, this is it. This is it. That's the asset that I can make millions of dollars off of. A tulip. This is true. Again, you're more than welcome to check it out. Today, an average house in the United States costs around $230,000. That's the average. That's the median in the United States. Back then, I want you to compare that number to back then. One tulip would sell for an average or a median value of a house. So imagine buying and selling a tulip for $230,000. And people are looking at it. If you think this is weird, why a code today worth $106,000. That's a Bitcoin, by the way, in case you're not following. Why people were willing to pay $126,000 for that code? And I'm dead serious, folks. I was attacked. I'm going to say it. I'm recorded. I was attacked because I criticized people who invest in Bitcoin. And I will today, and I will tomorrow, and after tomorrow. And I still believe it is a bubble because there's no fundamentals, folks. And I'm not the only one, by the way, saying that. No. If you think I'm the only one, you're wrong. Bitcoin does not, any cryptocurrency does not have fundamentals. And I'm not here to give you a lecture about fundamentals and fundamental analysis versus technical analysis. This is not the goal of this presentation. This is just to tell you that we don't have what it takes to support that price. That 126 or 106 as of today. I don't know what is it today. To drop or go up and down, whatever. So anyway, so this is us chasing hot assets, not necessarily stocks. It could be hot assets too. Overconfidence. Guys, overconfidence is a killer. And I think it's self-explanatory, so I'm not going to waste any time going over confidence, but I'm going to tell you one interesting study that was done in Wall Street Journal. So Wall Street Journal started about 10 years ago. They started looking at portfolio managers, pay attention to this. This is very important. Portfolio managers, male versus female. Male versus female. And 10 years ago or so, they recorded that female, on average, portfolio managers beat men portfolio managers. And they were, why? This is it. Female tend to have less overconfidence. They make big ones. They're more careful the next year. We make profits. I got it. It's me. I know the market. It's me who did it. And I am overconfident and I overbid the next period. And this is why many male portfolio managers, they never have that consistent, good, positive record of beating the market. Female, yes. 10 years. I think they report this every year right now. If I'm not mistaken, they follow these portfolio managers. So bottom line is overconfidence is a killer, literally a killer. Trying to time the market, I think this is a no-no, folks. I really cannot emphasize this enough. No one can predict the market. Just no one, folks. We get this question every single day. Now, every single time the market crashes, every single day, where do you think the market will go? How do you think the market will go? Do you think NVIDIA is the stock to buy? Do you think Apple is the right stock to buy? Do you think Microsoft is? Do you think nuclear will be the next thing? And I was like, whoa, what do you think? I mean, even ChatGPT won't give you an answer to these questions. Who do you think I am to predict the market or time the market? Folks, I thought I am smart enough and I can do this. I was naive, I'll be very honest with you. I received some news in 2018 that the largest ever, at that point, the largest group of economists from Ivy League schools decided that the market is due for a crash. 2018. Nothing happened. 18, nothing happened in 19. We got COVID, and that's when the market crashed, right? Because of, and even after that crash, it recovered very quickly. So now we're getting that same exact question. Do you think the market will crash? We have this administration, we have this guy, we have that guy, we have this news, we have China. And I was like, if I know, do you think I will be talking to you? I am serious. I know you hear this a lot and we laugh. If I know this information and I have a confidence level or certainty level above 50, you will not see me standing here in front of you right now. I promise you that. No one knows. In fact, and this is for you, younger generation. Guys, let me ask you a quick question before I throw this at you. If you find a gold mine, would you go tell others about it? If you discover a gold mine right there in that corner, would you go and pop, hey, I found a gold mine, come. Would you? I'm asking you, would you?
No.
Why do you think YouTubers are all day long recording videos, sharing with you investment tips on how to become the next billionaires? This is a very honest question. Go ahead.
They want the money.
Thank you. They want more people to watch, more people to generate money off of, well, you know, more ads, more viewers, more. But all this, to me, if you ask me, all this is BS. Excuse my language. No, do you agree? No, seriously, do you agree? So this is why I hope that when I push this on you, I want you to have that mentality of, what am I watching? What am I wasting my time on? I hope this is not for me. Somebody calling me? Last thing is ignoring fees and taxes. Folks, many people, and this is to the ones who used to trade and still trading extensively on the market, like daily traders. All right, they will tell you, oh, I did the math, and it turns out I made this year 18% return. Celebrate, and let's go to Longhorns. Everybody's the whole entire restaurant on me. I got you 18% return. What they're missing is when they get their 1099, right, is that they have to pay such and such in taxes. And I'm going to just throw a number. Let's say it's around 15% of whatever income they made, and another. I'm just going to throw a number. Another 3%.
You failed.
Can you mute that, if you don't mind, Stephen? All right. Another 3% in fees. Dr. Yaseen, I trade in Robinhood and Charles Schwab and whatever, and they don't make us pay fees. So I'm good there. I don't have to worry about this. You're actually wrong. You know what we discovered? And again, I hope I am right, but this is based on many readings that I did over the years. How do you think people like Fidelity, Robinhood, Schwab, and many others, they host your account for 0 fees? So you trade for 0 fees. How is that logical? Can somebody explain it to me? And yes, I'm not talking about the subscribed accounts, the subscriptions that will give you access to the databases. No, I'm talking about 0 free accounts. Can somebody tell me?
Paying you to put the money there on the exchange.
What do you mean?
So if there is a 0 fees and you can trade for free, that means that you're paid to put the money there and start trading.
Sure, but let's assume that the minute you put your money in cash, right after that, bam, it's invested in stocks. So now it's in the stock market, not with them. How are they making money?
If I want to withdraw the stock, I will have to pay.
No, forget. Let's assume that all of us buy and hold. How they're making the money?
With a lot of money, they will pull the money and.
Remember, all the money is in the stocks, so they don't hold any of it. His idea is that as long as there is cash there with them, they can take this cash and reinvest it. Are you guys following? Right? I mean, this is the logical. No, all this cash, let's assume for a second, all this cash is invested in the stock market. How are they making their money? 2 ways. 2 ways. Number one, and this is the one that is available to the public. This is the one known by the public. They buy in the wholesale market. So when they go and buy a stock, they don't buy what you are paying for it. So they go buy it at, let's say, 50, and they sell it to you at 51. This is how they make their money. But Yaseen, isn't that legit? Oh, no, it's not. Wait till you hear the second part of it. So you think what they do is, oh, they have it in their inventory, right? The stock X, Y, and Z. We're not going to call it any stock. And they will have it for you. When you come, they can sell it to you. What you don't know, a few years ago with AI and very advanced algorithms, you submit your order. In less than a millionth of a second, that algorithm will go and buy the stock from the market at 50 and sell it to you at 50.5. This is the secret that they will never share with you. Yes, probably I exaggerated by throwing that 50 and a half, but it's usually few pennies here and there. And as you can imagine, it adds up. And that's a huge amount of income that they can generate. Yes, please.
Does that happen only with like when you're talking about individual stocks or
Everything.
ETFs?
Everything. And if you don't believe me, watch a video or an interview. It's not a video, actually. It's an interview with a guy called Michael Lewis, if I'm not mistaken. Michael Lewis realized, he was a portfolio manager. He realized that each time he submit an order to buy or sell, the market is always against him. What does that mean? You submit an order to buy at 50, the price that order is executed at is 50.1. He was like, why? I mean, I thought that the market is at 50. How many of you know the market order and what it means, the market order? Market order, that means is you submit the order as is, and it gets executed at the best available price. That's what it means in literally plain English, right? So you are never guaranteed this price. You're never guaranteed this price until that order is executed. Are you guys following? Right? So always, there is a chance that the market be against you, this case, or might be in your favor. So you may end up getting it at something like that. Are you guys following? This guy noticed after thousands of trades that the market is always against him, whether he buys or sell. He said, I felt at some point that somebody's watching me. Somebody's literally standing at the other end of that line, internet line, watching my trades and taking the opposite position. That was back in the early 2000s, folks. Imagine what AI can do today. Just imagine. Okay. And again, Michael Lewis, I believe that's his name. I could be wrong. Just watch it. He had a long interview in 60 seconds. Watch it. It's very, the guy left the United States because he knew that there's no way around this. And now he has his own exchange in Canada. He has his own exchange, like the full exchange, like New York Stock Exchange. He has a small one in Canada right now. Anyway, are we good, folks? Are we following? And I apologize for going. I'm going to cover this very quickly because we have a lot to cover, but this is an important, very, extremely important. Guys, many people do not understand this. What you are looking at is a very influential principle we called dollar cost averaging. If you're into this world, you will hear it a lot. If not, if you never meet with your advisor or someone who speaks this language, you'll never hear. What does it mean? You can dump your money into a stock day one, and you will see it after 8 months, it's still 10, no return, zero. That's what you see in blue. However, what you can do is every month you do that buy. Every month you do that buy, whether the market is above 10 or below 10, and you will be surprised that you will do better. This is never something we in the field of finance did. I can guarantee you this. We're very advanced when it comes to math, but I can guarantee you that mathematicians discovered this, because there's no way for us to have this advanced knowledge in math to capture this. But we always tell our clients who exit a position, so they liquidated the position. I was like, oh, move my money to X, Y, and Z fund. We'll tell them, slow down. Let's not do it that way. Let's not just move and dump. Let's just do the dollar cost averaging. Let's slowly get you into that new position, right? It's much more beneficial for you. Some will tell you yes, some will tell you no. Just execute the order right now. Okay, so we have to do a little bit of education. But guys, this is, by the way, taken or keeping in mind that you're doing this over only 8 months, January to August. I want you to extend this to years. So this is why we keep saying, invest your money in that 401k on a regular basis, because you're going to take advantage of that cost. Oh, but Yaseen, I'm not gonna contribute anything right now in the market because you said in that presentation there's a very high chance that the market will crash. What did I tell you? Even if the market crashed, even if the market is, Just continue to buy, continue to invest, continue to contribute to that 401k. Anyway, let's keep moving. Tip number 3, diversify your portfolio. Diversify, diversify, diversify. Always, always, always. Never put your eggs in one basket. Always. Always have a well-diversified portfolio in multiple asset classes, even if you're all stocks. That's perfectly fine. You're young. I don't think you should have any bonds. That's perfectly fine. Within the stocks world, have a well-diversified portfolio. Some in pharmaceutical companies, some in the financial industry, some in the automobile industry, some here, some there. This is what we call diversification. I teach my students in the investment class, I tell them 30 stocks, that's all it takes to have a well-diversified portfolio. Dr. Yaseen, can I dump all those 30 stocks in my technology sector? I was like, how do you expect to be well-diversified if you're putting all your eggs in one basket, all your investments in one single sector? How do you expect to be diversified? Right? Yes, please.
And if you were to put all your money into the S&P 500, would that not be diversifying?
It's 100% diversified, 100%. And this is why I am a big advocate of SP 500, big advocate. Folks, and I'm going to tell you about where I put my money, Charles Schwab. This is their fee, which we will talk about in a minute. This, folks, pay attention to this. This is the fee of, if I'm not mistaken, it's Charles Schwab. I think this is the simple for the fund, which is, to me, this is the one that mimics the movement of SP 500 to a great extent. Yes, we have something that mimics the movement 100%, like the in Vanguard, the VU. We have the Spider. Those literally mimics the movement of SPI. But this one in Charles Schwab is the closest, if I'm not mistaken. You know what that 0.04% means? On every $1,000, you pay $4. So this is what I call low fees. And you will hear me talking about it in a second. So yes, yes, and yes. You're diversified, and on top of this, you have low fees. Okay. Good question. All right. Be well diversified. When we say diversified, we need to understand asset classes very quickly. I'm not going to spend too much time on that. All right. Stocks, equity, bonds, debt, equity, debt. We go to cash. Cash is king, folks. I don't know if you've heard that term before. Cash is very important, but not when you're losing opportunity. Having cash will allow you to take opportunity when the time is right. But the problem is for you to sit that cash, not earning any income, right? And wait for the right opportunity that could take years to come, that's a waste. So this is why I am very, very, very conservative when it comes to cash. I usually advise clients to keep less than 5, 4, even 3%, depending on the size of the portfolio. If it's millions and millions and millions, we'll say, you know what, 5% is okay. But if you have a couple $100,000, less than 1%, less than 1%. All right. Alternatives. Actually, we were talking about them today in our investment class. Alternatives, folks, is anything else, anything. Cryptocurrency is right there, right? Gold is right there. Silver is right there. You name it, it's there. Problem is with alternative collectibles is right there. Antiques is over there. Old cars are there. Anything, you name it, right? That could get you some wealth is classified right here, right? One major problem with these is you have a 50-50 chance. Really 50-50 chance. And I just talked about cryptocurrency. You get it. Oh, but I'm going to tell you what my mom told me 20 years ago, and what my wife now constantly keeps saying: gold, 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 gold. Yaseen, buy gold, 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 gold. And I was like, what is it with gold? What they see is this out of this history. So again, today in my investment class, I don't have this chart for you guys, but I want you right now, if you're online, just gold versus SP 500 over the last 25, 30 years. Just look at that chart. And I'm just going to throw it here for fun. So this way you can confirm Do we have any razor over here? Yes. This is literally the chart that I was showing about an hour ago. Difference between gold and SP 500. And I kept reminding my students as I was drawing this, that SP 500 is not the most aggressive fund in the market. This was assuming that everybody's starting at 1. This was gold. And this was SP 500. I want you to look it up right now. If you're online, just go look it up. So how can you convince me that this is an investment vehicle? Store of value, yes, absolutely. When the world collapses, when the whole world collapses, like it's done, it's Armageddon. This is your asset. But can you tell me for sure that it's Armageddon tomorrow morning? Exactly. So this is my problem with investing in gold. For ultra wealthy, not wealthy, ultra wealthy clients, my advice is 5%, maybe 7% in gold. Assuming that the market, the whole world will collapse and all of us will vanish, and that individual, that 5% of gold that he has will become so valuable, and will offset any losses in the 95% of assets that he lost. So yes, it makes sense in that scenario. Other than that, absolutely not. Zero gold. This is my advice. And again, you can do your own research. All right, done with this. Let's keep moving. Love this. I love this. Please, I'll be more than happy to share this with you, right? And you can look it up yourself. But this is for people who try to time the market. Who's the winner? Who's the best? Who's the worst? Look,
I did share the link.
yeah, please. Yeah, I'll send it to you. All right, so China equity. Let's all buy China equity. Where was China equity a couple of years ago? Look. So this is you trying to time the market. Oh, no, it's this asset. It's this stock. Market is unpredictable. Market will move in a way that is never predictable. No one, folks, we have been following data for the last 126 years, to be exact, dissecting the data, and we could not find that pattern yet. We just could not identify it. If you can, share it with me. And yes, I'm recorded now. I will give you $1 million. Yes, right now, I will give you $1 million if you can share that proof to be true pattern, because there is no one. Right? Look at the market. This is assets over time. But what's true is one thing that I want you to keep in mind. We're on the top. And we will continue to, and this is, by the way, the average over the so many years. We continue to be the top. So this is why we keep saying, just invest your money in the US market. Yes, on average, we continue to be on the top. All right, guys, so enough with this. Can I exit that? Running out of time, I know, please. There you go. Yep, I'm back to this. Perfect. All right, so very quickly, technical versus fundamental analysis. I think I explained, I know I briefly talked about this, but let me, now that it's on the slide, let me just explain what technical analysis versus fundamental analysis is. So this is what we call technical analysis. I don't know if you've seen anybody doing this online, but they have something that they call the support level and resistance level. Have you seen those charts before?
Yes.
Good. This is BS. You know why? Because they can sell this to a fourth grader. They can sell, anyone can understand this. Literally a fourth grader can buy this. This is so easy to sell. Hey, when the market drops, remember, the market's right here. When it gets close to this, that's when you have to buy. You know why? Because the market will bounce back and you will. And I was like, who said so? Why did you skip all this and you focused on this? Why? And they will give you statistics that prove that they are right. Oh, no, statistics does exist. But remember, as my advisor, Don Lee, told me once, he said, garbage in, garbage out. I don't know if you've heard this term before, garbage in, garbage out. If you're feeding garbage data and not capturing the full sample and accounting for standard deviation and many other statistical qualities, your output is manipulated and therefore garbage. That's what it is. And that's exactly what they do, right? Fundamental analysis, to the contrary of this right here, that's what takes weeks, if not months, to dissect a company. Learn their financial statements, accountants. This is why we need accountants. I'm dead serious. This is why we love accounting, because we need them to help us dissecting those financial statements. Know exactly how much this company made in terms of profit. What's their profit margin? What's their ability to generate more revenue in the future, etc., 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 etc. And usually it takes a team, an army of people to dissect this company. Not one or two or three. A lot of people. And again, if you're interested, we just completed our second stock pitch competition where my students and other students from the USG system, they come and compete using this fundamental analysis. Use this fundamental analysis. So they dissect the company and do the work. All right, very quickly, I'm going to go over the last 3 or 4 tips. Focus on low cost or cost index funds, and this is back to what he was saying. If you remember our discussion about the funds that cost the lowest fees, so that's very important. The 5th tip is to avoid timing the market, and I think we highlighted that as well. So I'm going to keep moving. This is a very fun experiment that I did a number of years ago, and I kept updating over the years. Guys, this is based on facts, so this is not me flipping a coin. What you see here, this is based on statistics that I obtained a while back from, can't remember the source, but I would like to say it's either Edward Jones or some other investment company. So what they did, they were looking at all accounts and they were identifying how many people buy and hold, how many people would buy a position and stick to it, how many people have perfect timing for the market. So really they can see when the market is dropping and picking up again. Very few of them. In fact, I think this is 0%. And then when people are emotionally driven, when I say emotionally driven, the minute the market start going down in red, exit the market. The minute the market start going in green, they enter the market. That's what this is. And then many of us are right here. This is the average investor right here. Okay, you know who these people are? They, just like my friend, they stay in the market, and when they see that it's dropping, that's when they exit right here, right? And they will never ever enter again here. They just wait. Oh, what if the market continues to drop? Because nobody knows that the market is bouncing back, right? So they wait and wait and wait, and that's when they enter the market. So they exit late and they enter late. They exit late and enter late. Bottom line is, look at their outcome. Look at the outcomes. This is your outcome. And this is just one stock. I can do this with anything. You can do this with anything. Just build that spreadsheet and play with the stock. So this is if you buy and hold 609% on Apple stock. This is if you are a perfect timer. So if you have that crystal ball, I told you, share it with me. I'll give you $1 million. If I can perfectly time the market, this is how much return I can make, if not more. This is if you are emotionally driven. So you react very quickly to the market movement. And this is you if you are the average investor. So bottom line is, don't time the market. That's what it is. Please.
Okay, so for the benefit of some of us, if you decide to buy and hold a particular stock, would you recommend that you still consistently invest in that stock? Say each
No. Stocks alone, no. I'm going to go back to what he said. Index fund, yes. Because one more time, where Apple today could be where Kmart was 20 years ago. Do you guys agree? You're probably not old enough to remember Kmart or Sears. No, I'm serious, folks. I'm serious. Back then, you're not old enough to know that Kmart was the Walmart, today's Walmart. Where is Kmart? Where is Sears? Name one mall in this country that did not have a Sears. Thank you.
Circus.
On Circuit City. So don't tell me they're too big to fail. No. This is the wrong mentality to have. So I hope you heard his question, and I know why he asked this question. I know you know better, but don't invest in a single stock by itself because no one is too big to fail. No one is too big to fail. Okay. I apologize. I'm taking a lot of your times. I am so sorry. Tip number 6, reinvest dividends. If you harvest any gains, reinvest it. Earn interest on interest. Earn income on income. And the very last one, set clear goals. I'm going to go back to the very first thing I started with. Set that clear goal. Set that clear goal. And it's okay to come back and readjust that goal and say, you know what? I thought, and this is true, I thought that $1 million will make me wealthy when I retire. Today, statistics shows that you have to have 2.1 million to be classified as rich. Used to be 1.7. Now, today, it's 2.1. To be classified as rich, today's statistic, 2.1. So it's okay to come back and say, you know what? No, I'm going to have to push more and save more, invest more in order for me to gain more. Okay, so this is it. I know I have missed some slides. I apologize. I'm over that 1 hour time limit. So I appreciate your attendance. I thank you for paying attention. Seriously, I wish every single class of mine are paying attention the same way you were paying attention. So thank you.